Hey, what's going on, everybody? We're here on episode 90. But if you are new to joining us, welcome. Hopefully, you get a lot of value out of previous episodes and this one as well. But let me give you a quick rundown of the two different formats that we have of this show. The first type is like today, it's a solo episode where we dive into different areas of finance, tax, cash flow planning, and other business consulting strategies. And in those solo episodes, we try to give you some tactics that you can actually run with. Whereas the second type of episode, we bring on a guest and they could have expertise. Either they are an entrepreneur similar to yourself and they'll talk about their challenges that they've overcome, some of their successes, things like that. Or they're people that support the industry as well, whether that be from a sales, marketing, legal, insurance, also tax sometimes with different expertise than myself. But in those episodes, sometimes we're not going as deep. It could potentially be more anecdotal. But today, like you clicked on, it's a solo episode. And we're really getting into how you can use your real estate for tax-free income. We're going to hit that from a few different angles. But I want to zoom out because, again, if you might be a new listener, you may not understand how tax strategy works because there's a lot of different ways that you can do tax strategy. For example, last week we talked about the tax planning scams and also basically tax fraud, which you can hear the term that tax advisors will call it tax evasion. That's fraud, that's illegal, and you don't want to do that. But when it comes to tax planning, and the goal often is to, well, the goal of tax planning, I've said this multiple times, but it bears repeating, whether you're a new listener or not, that the goal of tax planning is not necessarily to pay as little tax as possible this year. The goal is to pay as little tax as possible over a lifetime. So there's some time value of money to it as well, but that's the ultimate goal. So it's not inconceivable. Sometimes a tax strategist is intentionally having you pay more taxes in a given year if there's a strategic place that they're putting the money to avoid taxes forever into the future, at least for that taxpayer. So here's two terms I want to get into today that are going to prove important. It's tax deferral versus tax avoidance. So tax deferral is something you probably are very familiar with. It's like your traditional 401k, where you put the money in and you don't put money in today and you get a tax deduction for it. And you don't have to worry about the taxes until you're well into retirement in your 60s or 70s, whenever you decide to pull the money, maybe your 80s. But that's deferring the taxes because you're just taking a deduction today. And again, the people who do those, there's a strategic reason for the time value of money. Get the deduction today. Maybe you're in a lower tax bracket income-wise in the future. Cool. That's tax deferral. Then there's tax avoidance, which is arguably the best because you're getting out of the taxes completely. So one of the strategies that we talk about where it's tax avoidance is the S Corp, the S Corporation. It helps you completely avoid a portion of your self-employment taxes. Awesome. Another one that we talk about is shifting income to kids under age 17. If you play that strategy correctly, you avoid taxes completely. Today, we're going to talk about the same thing and how you can avoid the taxes completely using your rental property, your real estate property. I wish I didn't say the rental word because that's not the case here. We're going to talk about a primary residence. So how does that work? You could also use this with a vacation property as well, but you have to personally own it. So here's essentially the way it works. If you are willing to rent a property for 14 days or less, the IRS just gives you that money for free. Because for them, I believe, don't quote me on this, I believe this was part of like a paper reduction act, because they're like, all right, if you're only doing it for 14 days, then you can keep the rental income. Now, the rental income obviously has to be market rate. Essentially, the IRS is going to do what's called a personal minimum use test. And so your accountant should do this with you because the IRS, you can say, hey, I don't owe you anything. If you have less than 14 rental days, you don't have to file anything. You just keep the money. But You have to have rented it out for less than 14 days, and you as the owner have to have used it for more than 14 days. That's why these are usually pretty good for people that own the property as their primary residence or a vacation property that you actively use, and maybe you rented it out 2 weeks of the year. So again, the nice part is you get to keep the income. Now, you don't get to double dip. So just to keep the math simple, let's say you make $1,000 a day, so you make $14,000. During those 2 weeks that someone rented it out, maybe you had a cleaner come in, you have maybe a spike in utility bills, whatever it is, because maybe they had a big family or whatever. You don't get to have your cake and eat it too. So if you're going to take the tax-free rental income, you can't write anything off either. So you take the good with the bad right there. But like anything, if it's a vacation property or your primary residence, you can still put whatever you can on Schedule A. So like the portion of so it's like your itemized deductions. So that's your things like that, your mortgage interest, things like that. So you still potentially are getting some of it, but you can't specifically write off as the same way you would if you were a landlord and you're trying to reduce all your taxes with expenses, depreciation, taxes, all those things. You can't double dip. Again, you still get your taxes on your itemized deduction, all that. But in this portion, as a landlord, you're not filling out the Schedule E because you're just keeping the income and you're foregoing all expenses. Now, that's all well and good if you basically want to take the strategy of, all right, I have friends or family or whoever who are willing to pay market rate to rent my place for 2 weeks of the year. Cool. Just tax-free income to you. Do whatever you want with the money. However, people often use this rule to benefit their business and themselves, but that's often referred to as the Augusta Rule. Same concept. Well, it's the exact same concept. The rule is the same. You're saying, all right, I have this property, got popular because of Augusta, Georgia, the Masters, because they could get really high rates for people to come in, rent their place for a couple of weeks while the golf tournament is going on, and it's rental income. Now, what people do with the Augusta Rule is they rent from themselves. So what's cool about that is you can have a board meeting with yourself and your board of advisors at your home or at your vacation property. You can do that 14 times a year, and all of that income is tax-free to you. So it's a deduction in your business, and it's free income to you. Now, let's walk through some of the perks of this because there's sometimes confusion. Now, this does not, if you use the Augusta Rule, it does not impact your home office deduction. So if you have a portion of your home, let's say you have one room in your house dedicated as your home office and you're taking the home office deduction, that's fine. You can still do that. However, you can't double dip. So you can't, if you have, just hypothetically speaking, if you have a 2-bedroom condo, one's your bedroom and one's the home office, you can't do the Augusta Rule and rent out the office. You're already taking that deduction. So it would have to be in common areas like living room, dining room, the backyard, whatever it is. So you can still do both. That's the important part. Now, how does it actually work? So the business that you're running needs to actually be an entity. You can't do this if you're a sole proprietorship. So that is important. But most people probably listening, you may already be a one-member LLC. Maybe you're a partnership in an LLC, or you're an LLC that's being taxed as an S Corp. All those things, well, you could be directly an S Corp too, but for all intents and purposes, in those 4 scenarios, you can do the Augusta Rule. Now, how does it work in terms of what you decide to pay yourself? That's not really up to you. You have to find comps. So with this process, there does need to be documentation. You do need to do your best to document the process in case you're ever audited. So you're going to want to reach out to places that are in your area. They could be hotels, they could be co-working spaces. Find out what it would be to rent an event space from them or a boardroom from them for a day. Get them to give you a quote, and you want to keep those quotes as part of your record because you want to aggregate them and see what the average rates are in your area and price it accordingly. So for people listening that are in major metropolitan areas, that rental spaces are very expensive, this rule is going to benefit you even more because that's the rental rate you could use. So again, you want to document all this, and then you want to invoice yourself because your business needs to have a legitimate expense. So you invoice yourself, and then the business would, in that scenario, issue a 1099 to you, the owner of the property. So you would issue that 1099. Now, I will say this, and talk to your tax advisor, because sometimes you may, in some instances, do this through like a DBA, same thing we do with like children, because sometimes it doesn't look great when you are issuing a 1099 to the owner of an S Corp. But forget about that detail for now, because I don't want you to get caught in the weeds. I just want you to understand how this works. So you would issue the 1099 to yourself, and then on your personal tax return, you would essentially fill out a Schedule E, and the rental income would be zero, and you would reference the other deductions as tax code 280A, Section G. So that way you have no tax liability, but your business gets a write-off, and the business gets to issue a 1099 because for them it would be required because it's over $600 most likely. Again, you want to do this at least monthly because you want to get as close to those 14 days as you possibly can. So that's how the Augusta Rule works. Now, let me just back up for a minute to go back to if someone's doing this out of a vacation property. If you're doing it out of a vacation, if you are renting out, forget the Augusta Rule for a minute, but if you have a vacation property and you are renting it out the majority of the time, you can still be treated as a landlord as long as you're doing more than 15 days or more than 10%. That way, your accountant would just take a portion of the rental time. It would basically just run a calculation, like how many days did you rent it out? And then pro rata for the utilities, taxes, interest, things like that would all be based on that percentage. So if you have a vacation property that you like to use, but you're trying to monetize it, you can do both. Now, again, it wouldn't be the scenario we're talking about here where it's tax-free income, but you can still try to generate income, especially like with Airbnb and things like that. You can try to generate income on a property that you are personally using as well. So today was a shorter episode, but I wanted to bring this up, especially we're in the summer. People have vacation properties, and maybe you have a vacation property that you're not using as much as you thought you were going to. This could be a way for you to take advantage, or more excitingly, maybe you have a rental vacation property that you want to invite your employees, your team members, your board of advisors to spend a couple of weekends this summer and strategize for your business. Now, again, you want to document what you've done in those meetings because you need to have like the corporate minutes. I should have said that earlier as well. You have to document all this stuff. So when you're having with all the meetings, let's say there's 14 meetings, you do need to have corporate minutes, talk what you've talked about. You need to document this whole thing. And it shouldn't just be a tax strategy. You should be using it for your business as well. So it's a win-win. But hope this is helpful. As always, guys, reach out and we'll be happy to help. Have a great week.